Brien Lundin of the Gold Newsletter for Jefferson Financial. He's also a host of the New Orleans Investment Conference, and I'm really excited to have him join us in actually now and talk about why gold, what is happening to the gold price, what do we need to see to turn the ship around. Is today a bit of a rebound day? Brien, I'm looking forward to some enlightenment. What are we up to?
Thank you, Kai. I don't know if anybody has answers to all those questions, but thank you for setting the table. So setting the bar so high for me here.
That's what we do. You know, we're looking for answers, and you hope I hope you can provide them.
No pressure whatsoever. Well, I do have some thoughts, right or wrong. What I'd like to do is just jump into the presentation and try and establish basically the background story for gold that we have going forward and see how this recent turmoil kind of relates to that. So let me go ahead and get started with this presentation here and get her going. So really, why gold? So especially considering the kinds of market volatility that we've seen recently, we do need to check our premises and go back to that fundamental story for gold. So we'll go through that for a few slides here. First off, what we need to know as gold bulls, long-term gold bulls and or gold bugs, as it were, is that gold is the constant around which all other values revolve and against which currencies have always depreciated. This is the fundamental underpinning of the argument for higher gold prices now in this kind of a monetary environment. And what we need to appreciate is the fact that what we're seeing now is nothing really new. It's been going on throughout human history. If you look at this chart, for example, of the depreciation of the Roman denarius, you can see that this has already gone on. And if you see this quote from Cicero, he's saying a lot of the things that we're seeing in financial Twitter right now, people who are basically bitching about the overextension of the federal government, the intrusion of the federal government, the overspending. In this case, they were doing bread circuses, military campaigns around the world. Sound familiar? It's actually very relevant to what we're seeing today. Now, people say it can't happen here today. Let's look at the US dollar. And basically, this presentation will be done in terms of the US dollar and the US economic situation, but it does apply globally and through really every developed economy to some degree. So here we see the purchasing power of the US dollar has depreciated by about 88% since 1965, which is during a lot of us watching this video or this presentation today, during our lifetimes. But that 1965 date harkens back to when they took silver out of US coinage, the first step in removing any attachment to precious metals from the dollar and free floating the dollar as a fiat currency. The dollar went through a similar devaluation to the Roman denarius over a similar period of time. In actuality, the denarius went through a few periods like this. So it's not like we've reached the end, but we're on our way toward the end of the fiat currency experiment in the modern age. So what does gold do in an environment like this? Well, it appreciates. And you can see there are a lot of wiggles along this line, a lot of times when gold traded sideways, but when investors, when savers got worried about the trends in the currency value, in this case, the dollar again, when they got worried, then gold played catch up and reacted to the depreciation in the underlying currency. You'll see those peaks in the late 70s. You'll see that peak in 2011. And this is not an updated long-term chart, but the peak we recently reached after this post-pandemic monetary experiment. So what caused this decline? And going back to that chart, just briefly, it's generally an upward movement in the gold price during a depreciation of the underlying currency. Again, you have periods when it accelerates, but when the value of the currency goes from upper left to lower right, you see the corresponding value of the underlying currency going from lower left to upper right. So what caused the decline in the dollar's purchasing power? Very simply, spending and debt creation. This was a gross federal debt pre-COVID. I put this chart in my presentations toward the end of 2018. And at that point, This trend line going back to 1900 in the growth of the federal debt was an amazing 8.75%. Projecting that trend line, it showed that the federal debt would reach 25 trillion by June 2020 and 30 trillion by July 2022. Now that seemed crazy. It was already out of control at that point. When I gave these predictions for where the federal debt would be, it really strained what little credibility I had left at that point, because it seemed like there was no way the federal debt would grow that large. And of course it did, because a bad trend went to warp speed thanks to COVID-19. And the federal government just exploded the money supply. You can see this little blip up in total Fed assets that the Fed had already undergone some version of quantitative easing, although it refused to define it as such, going back to August and September of 2019. So it was already underway. They had already given up on their tapering experiment and attempts to normalize rates, and things were already a bit unsettled. But then, of course, we see what happened with COVID, and it immediately went overnight with asset purchases. They immediately went to zero on the interest rate and went into emergency action. Here we can see how dramatic that response was. These are the Fed's quantitative easing programs compared. The first yellow line, that's QE1. You can see they did about $500 billion in easing over about a year and a half. QE2 was a bit more than $500 billion over a shorter time frame. Then came QE3, which was unlimited quantitative easing without any restraints whatsoever for as long as it needed to be, and to whatever degree it needed to be. And that was tremendous. That was about $1.5 trillion over a couple of years, a little over a couple of years in Fed asset purchases. The red line is what the Fed did after the pandemic set in, 2.9 trillion in purchases immediately. Instead of doing it in the span of a few years, they accomplished this in the span of a few weeks. So they took everything they had done before and multiplied it. They accelerated every program they had before and then came up with some new ones. And this is another one in a long progress of these kinds of cycles that the central bank has done, and every central bank, frankly, in the developed world. Now, the Fed's QE infinity was immediately supplemented by trillions in stimulus spending, including helicopter money that, come to find out, you don't really need helicopters to dispense. That money was directly deposited in voters' bank accounts. The count so far, we had the year-end 900 billion stimulus bill, and that happened because they were afraid of using the trillion number. Then we had Biden come into office, 1.9 trillion stimulus plan quickly passed. A bipartisan $1 trillion infrastructure plan just passed. A progressive $3.5 trillion soft infrastructure plan passed just yesterday, and a $6 trillion budget and a projected $3.7 trillion deficit for 2021. A while back, I had put out this tweet that, like tequila shots, the first trillion is the hardest. We saw that in the $900 billion plan passed last year. They didn't want to use that trillion number or breach that barrier, but like tequila, after that, it goes down smooth. And we've seen trillion after trillion after trillion expended and added to, and there is no sign of any shred of budgetary restraint left, at least in the US economy and US budget. The result, of course, is exploding federal debt. You see, whereas we had projected 25 trillion in federal debt, and that seemed outrageous, we're now at well over 28, approaching 29 trillion. We'll hit that 30 trillion well ahead, in fact, of that forecast of July of next year. The debt to GDP ratio is around 130%. That is remarkable. That is a level that would have in past years really greatly diminished the credit rating of any government, but not anymore because it is accepted as being normal these days. So what are the implications of this massive debt load? Ultra low interest rates, essentially forever. due to the costs of servicing that debt. Now, how low can you go on the federal funds rate? What we've seen here is this chart goes back to 1980, and it shows the effective federal funds rate. And as you can see, in every little hiccup in the US economy, every recession, and even periods when there wasn't even a recession, the Fed has responded by resorting to the same old recipe. It has lowered interest rates. And in each one of these successive cycles and successive steps of decreasing rates, lowering rates, it has never been able, when it tries to normalize that, it has never gotten back to the previous levels or even the midpoints of the previous levels. It has never, in effect, been able to normalize interest rates to anywhere where they were before they started their rate cut campaigns. And that culminated, of course, in 2008, when it got down to essentially zero. And if you project it again in the next step, as they reached the foundation of the building, would be to go into the basement and go into negative rates. We're at zero rates now, and all the talk is of rate hikes probably early next year. The question remains of whether they'll be able to achieve that, because again, the next step is toward negative rates. That sounds outrageous, but keep in mind a couple of years ago, a budget deficit, a federal debt of $28.5 trillion seemed outrageous. Keep in mind that prior to 2008, everything that we're seeing today that we're accepting as normal, zeroed interest rates, massive government stimulus spending in multiple trillions of dollars, massive federal Fed asset purchases. All of this was deemed outrageous, crazy talk prior to 2008, and now it's accepted as normal. So we are going to see crazier times ahead in the next cycle whenever that occurs, if we ever truly exit the current cycle. The upshot of all of this is that the rate of interest on the debt can no longer exceed the rate of dollar depreciation, which is inflation, another word for inflation, or real interest costs will explode. Put another way, the cost of servicing the debt right now, if the Fed funds rate got to say 2 or 3%, the cost of servicing the federal debt would approach $1 trillion a year, just in interest costs. And in this current political environment, that would be unacceptable, and people would start talking about, why don't we just default on this debt, which would crash the dollar immediately. So the rate of interest cannot be very high. And in fact, the Fed funds rate has to be negative on a real basis, adjusted for inflation. This is one of the reasons why the Fed needs higher inflation, to give them room to cut rates, to raise rates and then cut rates in the next downslide, but also so that the cost of that debt depreciates more quickly than the cost of servicing that debt. Otherwise, the budget deficit blows up. The budget actually blows up. The upshot of all of this is negative real rates, essentially forever at this point, under the current monetary regime. So real rates do go negative. This is where real rates are right now. If you look at the projected inflation expectations as judged by the break-evens on the Fed TIPS bonds. So right now, rates are, according to this measure, the market's expectations of inflation going forward, real rates are negative to the tune of about 1.1%. But the real inflation rate right now is closer, as the CPI today showed, closer to 5.4%. So when you're looking at the real rate as measured by the CPI, as this chart does, then we are negative, essentially over 5% negative real rates if you're looking at the short end of the curve, and at least 3.5% toward the longer end of the curve. And it's getting worse. Now, 52 weeks ago, we had gold and silver and mining stocks at all-time highs. Yet the real rates were only positive. We're only negative really on the shorter end of the curve. Now we're much more negative on real rates, and the environment is much more conducive to higher metals prices. But markets look ahead and they're forecasting that inflation will subside, and they're basically believing the Fed at this moment in time. Now, generally speaking, gold loves negative real rates. This wonderful chart, which I've used many times from our friends at Incrementum and their In Gold Trust report, the blue shaded areas show periods when negative real rates generally were in effect. And as you can see, the gold price marked in gold in this line was buoyant during those periods. So back to Kai's questions, where are we now? This is gold post-pandemic. You can see the sharp decline in March, and then that major rise to August, then a long, slow correction, some hope in early summer, and then a big drop in June, and a big drop just a few days ago, a couple of days ago on Sunday evening, as it were, and a big crash. If you see here, we had a really mediocre golden cross, where essentially both the 50-day and the 2-day were falling or going sideways, yet the 200-day fell below the 50-day. So we had a technical golden cross, but here we're seeing that that's about to be reversed. And in fact, it has been, and we've had a death cross on gold. This is the last 3 months. This is that big decline on Friday and Sunday night, and then some attempts at a rebound. Today as well, we're getting a bit of a rebound. That's probably more of a reaction to an oversold situation in gold at this point, but I do believe the future long-term remains bright for the metal. For one thing, let's look at what happened the last time the Fed tightened monetary policy. If you look back to here in December of 2015, gold had gone through another long decline, and this one going back to essentially 2011. So about a nearly 5-year decline in the gold price. And then the Fed, all of this preceding the expectation, the market's expectation that the Fed would begin raising rates. I predicted at that time that in advance of this rate hike in December, widely expected that that would mark the bottom for gold. And sure enough, it did. And then we had a tremendous run, a very profitable run over the next 6 months in gold, silver, and the mining stocks. Whenever we get any form of actual Fed tightening, particularly if we get it in the form of rate hikes, I believe that will mark an interim bottom in gold and will be an exceptional buying opportunity, because it will release that selling pressure from the speculators in the paper gold and silver market, who are essentially betting on the direction of Fed policy, whatever the next headlines will be for gold. Right now, they're betting that the next headlines from the Fed will be some form of tightening. And once that happens, they will, having bought the rumor, they will sell the news and get out of their shorts on gold. Longer term, we see that there is a tremendous cup bottoming formation that's happened in gold, and we are now forming that handle. So this actually projects, when it's resolved, upward to about a $2,500 gold price, somewhere in that range. This is a very long-standing and powerful formation. So long-term, I think the picture, technically and of course fundamentally, for the reasons why I've just presented, the long-term case for gold is extraordinary, remains extraordinary. And what we're seeing right now is essentially a buying opportunity created by this flash crash. This is one of my favorite indicators, the 14-week stochastic. These charts, of course, come from my friend Ron Grease at thechartstore.com, a service I highly recommend. This shows the stochastic going lower. It's going to try and break through that 20 level. To resolve that, it would take, I would think, at least another 3, perhaps 4 more weeks before we see a chance for a return to upward momentum. So I do feel like we're going to have either downward or sideways trading for the next few weeks, but we will resolve at some point back to an upside. And essentially that means today's levels in everything are bargains. So bottom line, despite the recent volatility and weakness, a long-term money-based gold bull market is in progress, and that's important. This is based on monetary fears. It's not based on anything that's geopolitical or other kind of exogenous events. It is a long-term monetary-based gold bull market, and that's the kind that lasts a long time and creates extraordinary profit opportunities over that period. We can look at how far we might go. This is another great chart from our friends at Incrementum. Basically, if you back the US monetary aggregates, let's say M2, and let's say you back it by only 20%, that's a $10,000 gold price. That's where that number comes from, some price predictions by a number of people like Jim Rickards. And of course, if you went to 100% in some of the looser monetary aggregates, the numbers get really silly. Bottom line is that the targets in this run are very high, much higher than we're at today, and at levels that would be hard to imagine today. But that's the kind of market, that's the kind of situation that we're in, again, over the long term. What's the upside? This is gold's price peaks in today's dollars, inflation adjusted. If you went back to the January 1980 price, it would be over $2,800. If you went back to the 2011, it would be $2,100. So 55% gain from current levels. If it went up to 28, 18% if we went up just to 2011 or really 2020 levels. So huge upside in real terms for gold. For silver, huger upside. I'd like to see you translate that one, by the way, huger upside. If we go back to the January 1980 price, inflation adjusted, we would go up 6 times. And because this chart was not updated over the last few days, probably closer to 7 times just to get back to the real levels, inflation adjusted levels of 1980. Silver offers extraordinary upside. I tell people, if you like gold, and you should love silver. Hair and fire upside, of course, are in the junior mining stocks. This is one of our better picks in recent years in Gold Newsletter. Great Bear, up 47 times from our entry price in our Gold Newsletter alert service. That's the kinds of gains, although I won't shy away from that pick. That is one of our better picks, but it is an example of the kinds of gains that are available in the junior mining stocks when you have the wind behind you, as it were, when you have this kind of long-term monetary secular gold and silver bull market in play. Just a couple of words on us. Gold Newsletter is the gold investor's best friend for 50 years. In fact, this Sunday marks the 50th anniversary of Nixon closing the gold window, and in 1971, and that marks the launch of Gold Newsletter, which I still publish and write as the longest standing gold advisory, precious metals and mining stock advisory in the world today. It's goldnewsletter.com. I urge everyone to come to my New Orleans Investment Conference, October 19th to 22nd. Go to neworleansconference.com to learn more about it. And you can follow me at Brien_Lundin on Twitter.
Phenomenal.
Thank you, Kai. How did I do on time? Pretty good.
Exceptionally well. Yeah, we got quite a bit of time left for Q&A, and I'm actually looking forward to being a media partner at your upcoming event down in New Orleans. I'll be there as well, so I'm looking forward to that, and can't wait to see you down there in person.
Looking forward to seeing you. It's going to be a great event.
Yeah, it looks like it. You've got an amazing cast of keynote speakers assembled there, so can't wait to interview them all.
Yeah, they'll be there. Just grab them.
I will for sure. Let's do a bit of Q&A. Like, I have a couple questions for you, and I'm not sure which ones to start, because I think both questions I have in mind are expansive. Not expensive probably as well, but expansive in terms of format. I looked at Japan the other day, and the debt to GDP ratio in Japan is 250%, and they seem to be doing just fine. You just talked about 128% development was taken for the US. Is there actually a ceiling? Do you see the US going to 250%? And run us through that. What would that look like? What kind of environment would we have to deal with?
Yeah, Japan's a different case for a lot of reasons, culturally and demographically for sure. But the bottom line is it has not experienced anything like the kind of growth it had before it went into those kinds of monetary policies. So the economy has been stuck in some kind of a stasis for decades now. That's one possible alternative for the U.S. What is the next step? I don't think anybody knows, although, as you know, if you go on financial Twitter, you can see lots of people predicting the path and every step of the way, what's going to happen, not to disparage any of our friends, but do you have predictions on whether the dollar is going to rise first or just crash, then rise, and then crash, et cetera, et cetera? Nobody knows. And that's the underlying fact. Nobody knows for sure. I don't dispute a lot of these predictions about what's going to happen because they all seem well thought out to me and seem perfectly feasible as possible pathways forward. But one thing I am very confident of is whatever happens, whether it's this cycle that leads to the destruction of the credibility of fiat currencies or the one after that or the one after that, the direction is easy to determine. And the one thing we can be confident in is that in the days ahead, you're going to want to have a healthy allocation toward gold, silver, precious metals, mining stocks, and things in general, broader based commodities, et cetera. These are the big mega trends that are facing us. And you just want to be on the side of those. And, occasionally, like over the last 48 hours, check your premises.
No, you don't want to be caught off guard as well. You mentioned the U.S. dollar, so I have a follow-up question on that. And it is showing relative strength, and I'm trying to understand where that strength is coming from. You just mentioned all the stimulus packages that are being approved. You're mentioning all the money printing. Where is the strength in the U.S. dollar come from? And I'm still questioning, why does the world have so much confidence in the U.S. dollar right now? I think the DXY is trading around 93, so it's pretty much at a year high. And I'm trying to understand it. Yes, U.S. economic recovery. Where are we coming from, though? And also unemployment numbers of 5.4%, question mark, right?
Yeah.
What do you think?
It is interesting. A lot of things to unpack there. First, I haven't been that impressed about the so-called strength in the dollar when it's gone up, say, 3% over the last nearly year or so. It's not a major move, even for currencies. But it is the dollar, so everybody looks at it. And the other thing about the dollar, we need to look at it, understand that it is only a relative measure of how clean that shirt is in a dirty laundry basket. And it's only a measure of how it relates to other currencies. It's still an interesting question. I think part of it was that we had the Delta variant running rampant and this is recent strength, not very recent strength, but we had the Delta variant running rampant around the world before it hit the U.S. So that helped the dollar a bit. Now we see that reversing a bit. But we also had economic growth a bit stronger in the U.S. and that helped it. The bigger question to me is not so much the dollar, because it is just judging against other pretty bad currencies, but interest rates. Why have rates been falling in the face of a stronger dollar, in the face of the Fed floating trial balloons about rate hikes in the future? And I think that goes back to the fact that we have had a bit stronger economic growth in the U.S., but I think the bond market was also looking ahead toward the rise of the Delta variant and slower economic growth. So that was the most curious thing to me, because the bond market's pretty smart. And I think that's what it was discounting as recently as a couple of months ago when rates started to fall.
Interesting. You mentioned, of course, all the precious metals, mining stocks, and commodities to invest. We got a question in the Q&A chat here. What is the impact on gold by crypto? And how maybe, and let me expand on that, maybe, how does crypto factor in all of this?
Yeah, I think crypto has stolen some of gold's thunder, but I think it has stolen, most of the thunder that has stolen from gold has been the speculative demand for gold. I don't think it's stolen, a relative dollar's worth of safe haven or insurance demand for gold. And demand for gold can be, investing in gold can be divided into those two broad categories: insurance for your wealth, and speculative. If you believe in the macro trends that gold prices are going to go higher, then you can buy gold on that basis. You can buy mining stocks to leverage that move, as we all know. And I think that's the kind of demand that crypto has robbed a bit of for gold. I think the majority of people who are buying gold right now are buying because they expect, not gold, I'm sorry, buying cryptos right now are buying it because they expect it to go higher, not because they're looking at it as a store of wealth. They're looking at it rising in value and being able to sell it to some other person at a higher price down the road. There are some big institutional allocations, but those kinds of allocations are done for other reasons, not necessarily as short-term speculations. But I think a lot of what's driving the cryptos right now is the kind of speculation that used to drive the metals in this kind of environment. So yeah, I think it has hurt us from that standpoint.
Yeah, you mentioned FinTwit and mining Twitter and all that as well. Gold Twitter. We do look with a bit of FOMO at the Bitcoin and the Ethereum action, price action right now as well. Of course, we want to double every year. But gold is a 5,000-year-old or is it 6,000-year-old instrument, and my perception is that we've seen a lot of the run up already, value being created, which Bitcoin is trying to catch up to, and maybe other cryptos as well. So I'm quite curious. Like my thesis, and I've asked that in a lot of interviews, are we just too greedy as gold investors? Should we be a little more patient and just let things run its course?
Well, look at, we have actually gotten into in the price. I showed those charts for the inflation adjusted price of gold in previous peaks in real terms, but nominally at least, we've been in uncharted territory very recently. And so it's hard to come up with comparisons for that other than, real prices. But if you look at the first run in gold from, say, 1970 to 1976, the second run in gold from 77, 78 to 1980, the run in from 2000 to 2011. In all of those instances, we saw the gold price go up in nominal terms 7 to 8 times. And all of those were in periods where we had some type of monetary reflation going on, some type of debt creation going on. And the early 2000s took longer because it just wasn't as dramatic. But we did have the rise of China fueling a lot of that. By the way, China's economy is about 3 to 4 times larger now, so that's still an important factor. So if we look at the low in this latest cycle, post-2008, as being about $1,040, that implies at the end of this cycle, however long it takes, whether it's 3, 5, 7, 10 years, that the gold price will be 7 or 8 times higher, because that's generally what it does in these kinds of monetarily based bull markets, secular bull markets. That, of course, implies a gold price of $7,000 to $8,000 by the end of this cycle. So again, we can try to figure out the details and the exact path that it's going to take step by step. But generally, I think that's the big trend we need to invest on. We need to take advantage along that trend when we have buying opportunities. Check our premises along the way, and don't forget to take profits along the way.
Taking profits is a good point, actually. Yeah, definitely
Toughest
do that.
thing to do.
But first, you got to generate some. And as a newsletter writer, I can't let you off the hook here easily. And we got to talk about your top picks. What can you share with us? Some companies, like you mentioned, Great Bear, of course, had a great run up. What company could be the next Great Bear?
Ooh, that's a good question. I didn't think you were going to ask me some of my top picks right now. I like Erdene Resource Development. They have some drill results coming out soon. I actually haven't even checked the market to see if they're out yet, but they do have some coming up soon. I like that company. I like Maple Gold Mines for the longer term. They're at a good level right now. They've got a huge land position and partnership with Agnico Eagle. For a drill hole play, I like Ophir. I forget the symbol on that, but they have a good target that they're drilling right now. Those are a few of them.
Not good. OPHR is a ticker. I'm a shareholder, so
Good.
Yeah, we'll see. I like Idaho, so we'll see where it goes.
Yeah, me too.
That's more of a longer term bet in my portfolio. So, and I just been passed the note. The results for Ardeen are out, so we got to go check them out together later. And,
okay. I knew they were imminent. I didn't know that they were coming out that soon. So
great. Brien, it was fantastic having you on the program. Thanks for clarifying a few things. Thanks for helping us understand what is happening in the markets. And of course, $7,000 gold. I'm curious what needs to happen in the world to see that, because I think things were going to be out of whack if we see that price. So, but I'm looking forward to, let's say, $2,500, as you mentioned at the beginning of the presentation. Companies are still making money hand over fist. So I'm quite curious.
That's true.
What the next few quarters will hold for us as resource stock investors as well. Good luck with the conference, and can't wait to see you in October down in New Orleans, Brien.
Me too. Thanks a lot, Kai.
Fantastic. Thanks so much.